Good morning. My name is Miguel Gonzalez, and I'm a retirement specialist with over 19 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about divorce. Experiencing a divorce is rarely something couples expect to face, yet inevitably some marriages do unravel, affecting each partner's financial life in the process. While divorce overall has been steadily decreasing, it's still common in the United States. In fact, among those 50 years and older, the divorce rate has doubled since 1990 and tripled for those over 65 years old. Your financial situation can be one of the most important elements to understand as you navigate a divorce. One often overlooked aspect of divorce is the decreasing in income all parties suffer. On average, men typically see a 25% decrease in income following a divorce, while women can experience a decrease of over 40%. With this in mind, it's no surprise that women often experience greater financial hardships following a divorce than men. Additionally, those who go through a so-called gray divorce, which is when you split up after age 50, are nearly 9 times as likely to have financial challenges at age 63 than their continuously married peers. With the right strategies and guidance, you may be able to help control the setbacks that many people experience during a divorce. Regardless of what your current financial standing is, your post-divorce life should start with identifying all of your personal assets and searching for any potentially hidden assets. These details include everything from loans in your name to investments held in both spouses' names. By doing so, you'll be able to claim the finances that are yours, separate property, while divvying up the ones you share, which is considered marital property. From there, you can start the process of organizing your financial life. Navigating a divorce is rarely simple. However, with this video, you may be able to take some of the complexity out of the equation. Money. Cover expenses and support your single life divorce can be expensive. Not only do you need to afford your new lifestyle without your spouse, but you also need to pay for the divorce process itself. In fact, the average cost of divorce is $15,000 for each person, which includes court fees, attorney's fees, and taxes, among other expenses. Furthermore, the costs continue even after the divorce is final. People typically need their income to increase by 30% after divorce to support their standard of living. For people divorcing who are 50 years and older, the change can even be more drastic, with wealth often decreasing by 50%. From splitting bank accounts to identifying your net worth, how well do you manage your money plays an important role in setting up your new life stage. Here are some ways to help you address money issues during a divorce. Identify ownership. We just talked about it. You should have started the divorce process by listing out which assets you're considered marital property and which are separate property. These details come back into play when you're addressing your money. You'll need to clearly know what you own versus what you share, and from there you can divide them up accordingly. The other thing to keep in mind is create your net worth statement. By knowing what assets you own personally and jointly, you'll begin to create a picture of your financial worth. You'll need to capture these details in a net worth statement that subtracts your liabilities from your assets. But keep in mind that this statement reflects where you are in your financial life today, not tomorrow. So as you unwind your finances, focus on actions that move you forward with a stable foundation. I also recommend untangling your investments. While you and your spouse were married, you may have built part of your financial life together through investments. Those assets contribute to your net worth, what you each own separately and together, and what investments you need to split. A variety of details can affect how you split your investments. Here are some questions to consider when you're thinking about splitting investments. Short-term versus long-term needs. Do you need money now to help you both transition this new life stage, or can you let some of your investments continue to increase in value? Delayed earnings. Did you invest in something that started earning only after you were married? Or did your investments accrue value before marriage? Very important to know that. best fit? Is receiving an investment during settlement the right financial fit for your needs? Or would other financial options help you transition better? Reinvested settlement money. The hope is that after your divorce is finalized, you'll have cash settlement that's large enough to help support your immediate living costs. However, an important detail to consider is that after a divorce, individual living costs can be as much as 50% more than expenses for a couple. As a result, ensuring that you have enough income for both today and the future is very important. Assuming your income needs meet your needs, one way you can use your settlement money strategically is by reinvesting it. By doing so, you may be able to grow your money for your future needs while also supporting your quality of life. Also, keep in mind that safeguarding your lifestyle in retirement is important to consider as you're going through a divorce. Retirement accounts often hold a significant portion of people's assets, especially if they've been accruing for years. When divorcing, it's critical to negotiate how you will split these accounts. Your choices largely depend on the state you live in, so make sure that you work with your financial professional and legal counsel before making any moves. From defined benefit plans to pensions, separating retirement savings in a fair manner can be complex. With thoughtful consideration, however, it's possible to soundly address them and minimize complexity. As you move to divide retirement accounts, here are some details to keep in mind. Taxes. Taxes is a big one. How will taxes affect your retirement accounts, either now or in the future? Do you need to roll money into something like an IRA? Prenuptial agreement. If you have one, keep in mind that if you do have a prenuptial agreement in place that defines how you must handle your retirement assets, you need to follow. Financial stability. Is your retirement account, is it being split or is it being transferred? How will this change affect you financially? On the flip side, if you're receiving these funds in a settlement, how well do they support your retirement? And do they have gaps that need to be filled? Your current living needs. We talked about this before. Do you have enough money to cover daily expenses? If not, will you need to address the money from a retirement account to help you? Alimony from retirement investments. Today's tax laws don't recognize alimony as earned income, so you can no longer use alimony payments to fund retirement accounts like IRAs and Roth like you used to be able to do. How will this change affect your financial strategies for retirement? And then the qualified domestic real estate order, which is also known as a quadro. A quadro is a court order typically used for divorce agreements that states how much an ex-spouse needs to receive from the individual's retirement accounts. This amount is often 50% of the asset's value accruing from the marriage's start through the divorce. A quadro may benefit a spouse who earns less income, and individuals can list other family members as beneficiaries to the quadro, such as their children. These orders are only applicable for IRS tax-qualified plans covered by the Employment Retirement Security Act, ERISA. Having a quadro isn't required for all types of retirement accounts. However, it can protect your financial interests more than your divorce agreement alone by requiring this financial relationship when splitting retirement assets. Your specific financial needs and goals will help determine whether a quadro is suitable for your divorce agreement. Keep in mind that the quadro, to be officially recognized, both the plan administrator and the court must approve the order. Managing tax liabilities. Taxes will almost certainly play a role in your finances during the divorce process, as I previously stated. From splitting investment accounts to managing alimony, pay attention to how taxes may affect your health. Will help minimize and maximize your settlement outcomes. Keep in mind that this video is for informational purposes only and not a replacement for real-life divorce tax preparation advice. Also, tax rules are constantly changing, and there's no guarantee that the tax treatment will remain unchanged in the years ahead. A legal professional may be able to address your specific questions. Here are some key areas to include in your strategy. Filing joint tax returns. If you filed joint taxes, that's important to know that the IRS considers you still married if you haven't finalized your divorce by December 31st. As a result, separated couples, even if you've already filed for divorce, may be required to file joint tax returns in that tax year. If you never filed a joint tax return and have a dependent, you may be able to file as head of household depending on whether the IRS recognizes you as an unmarried. Your tax professional can help you identify the steps you need to take. Paying and receiving alimony. It's kind of the final stage, but paying and receiving alimony, thanks to tax law change in 2019, alimony paid to an ex-spouse is no longer tax deductible, and those who receive alimony will no longer pay taxes on it. Legal fees paid to an attorney due to alimony arrangements may be able to be no longer tax deductible. If any of these items were listed in a pre- or post-nuptial agreement, they may be nullified as a result of the tax changes. Addressing child support. If you have children when you divorce, then child support is likely part of your settlement. For the person paying the child support, it's important to note that these payments are not tax deductible, nor is the income received. Also, no one will pay taxes on child support money. These standards apply to divorces finalized after December 31st, 2018. Claiming the child tax credit. If you have children who live with you for the majority of the year, then you may be able to claim the child tax credit worth $2,000 in deductions per child. For other dependents over the age of 16 years old, you could claim up to $500 per child. Parents who don't have custody can only claim this credit if the other parent signs a waiver allowing them to do so. Paying capital gains taxes. Property that transfers during a divorce isn't taxable during the settlement. However, capital gains taxes may apply if you sell the property. Since the tax basis shifts during the divorce settlement, you may need to pay taxes on the value it has accrued before and after the divorce. Updating your estate strategy. Your estate includes more than just your retirement account. It includes your home, your car, your art, and your antiques. Essentially, everything you own factors into your estate. Protect your assets by going over your estate strategy with a fine-tooth comb with the aid of your financial professional and an attorney. Protect yourself with insurance. Your insurance policies need to be reviewed during the divorce process. From removing your spouse from accounts to revisiting your policies, pay close attention to insurance during the divorce process. Connect with your insurance professional to make sure that all your policies have been updated. Several factors will affect the cost and the availability of life insurance, including age, health, and the type of amount of insurance purchased. Life insurance policies have expenses, including mortality and other charges. If your policy is surrendered prematurely, the policyholder may also pay surrender charges and have income tax implications. You should consider determining whether you are insurable before implementing a strategy involving life insurance. Any guarantees associated with a policy are dependent on the ability of the issuing insurance company to make the claim updates and payments. Make sure you update your beneficiaries. This is very important during divorce. If your former spouse is a beneficiary on your insurance account, a finalized divorce is a good time to update these details. Sometimes a court order may make you keep your spouse listed as a beneficiary. In these cases, you must follow court orders. If you have no limitations and you have children, then updating your beneficiary information to remove your spouse and add your kids can be a helpful strategy. Here are some details to keep in mind. Designating your estate as the life insurance beneficiary could cause your heirs to go through probate, which is an expensive process. Designating children who are minors is complicated, and your best option could be to set up a trust in their name as the beneficiaries instead. The takeaway is, going through a divorce is rarely a simple or inexpensive process, as I've just discussed. You can help protect yourself and make the most of your opportunities by working closely with your financial representative and other divorce professionals. It may help decrease complexity, remove uncertainty, and improve fairness for all parties involved. Remember, if you have any financial questions, we can help you navigate a complicated landscape and collaborate with your legal and tax professionals. Your happiness is ultimately my concern, and we're here at every step of the way. Once again, my name is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the icon and don't forget to subscribe to my YouTube page and the YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.